Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu, and on today's show, we have Alex Molyneux, who's the CEO and Managing Director of Galena Mining. How are you today, Alex?
Good, thanks, Kareem. Thanks for having me.
Let's begin by going through some of the highlights within your career, Alex, and let's talk about your experiences within the different sets of commodities that you have been involved with. I think listeners would be really interested to hear about your time at Ivanhoe Mines and as well as at Paladin Energy. Can you talk a bit about this?
Yes, of course, Kareem. For my career, I started. I guess I left college with an economics degree, and the bulk of my career has been spent roughly half in investment banking and then just over half as a mining industry executive and financier. And when I left university and I went into investment banking, I enjoyed the physicalness of the mining business and trying to understand the physicals and how they relate to the cost structure of these companies and, how does the volatility of the commodity cycle and whatnot affect how they should be run and investment decisions. So I had a long career in investment banking and that culminated with me becoming a managing director, head of metals and mining investment banking for Asia and Australia for Citigroup. I was based in Hong Kong at that time, and Robert Friedland, the well-known mining entrepreneur, was a contact of mine at the time, and he convinced me to join his group of companies. And for me, that was a great opportunity because primarily because I could move into the client side of the business, understand the actual management side of the mining business in a business that was quite diverse and with the support of Robert and his network. So I kind of went across to Ivanhoe Mines and I sort of had a number of roles with Ivanhoe Mines, including CEO of the coal business, South Gobi Resources. I was on the board of the oil business, Ivanhoe Energy. I was very heavily involved in the corporate development aspect of the Ivanhoe Mines group, and it's being an entrepreneur-run organisation. It's your roles in that kind of business can be a little bit looser than in a traditional sort of corporate structure. But I learned a lot about exploration. I learned a lot about the dynamics of conceptualizing mining projects and even going through the construction phase and marketing the product and also financing. So we did lots of equity raisings. We did sovereign wealth government bond in that time, a whole bunch of different things. And so that, in a way, that period gave me, combined with my investment banking experience, gave me the tool set that then I subsequently used in my career thereafter. And since I left Ivanhoe Mines in 2012, I've done a whole mixture of things, including a number of public company boards, both Canada and Australia, and also a lot of private investment in the mining industry, some public investment. Some of those things that I was doing, including doing a lot of work in the uranium space at that time, led me into the job at Paladin Energy, where a number of stakeholders that were involved in Paladin invited me to join and basically help that company go through a restructure, both in a corporate sense, in a business sense, and then in a financial sense. I think many people might know that when I joined Paladin in 2015, uranium was kind of halfway or just over halfway down on that long drop after Fukushima. The company basically had more than $700 million worth of liabilities. It had $150 million market cap. It was burning cash in the operating business, and it was it needed a lot of active management on behalf of its stakeholders in order to come up with a plan that allowed the company to survive, recapitalize. We basically suspended the listing, dealt with all of the creditors. At the same time, we were implementing a lot of change in the mining business to cut cost and whatnot. And then we had to continue to raise capital all the way through, do bank financings, refinance various bits and pieces, and then eventually we were able to come up with a deal that eliminated most of the company's liabilities, and we issued a new $115 million bond and relisted the company on the ASX. And it was that was a very intense period. And so at the time, I basically had said, look, I'm interested to go and do other things after the restructure is successfully complete. And that's when I was approached for the Galena role. But I transitioned from Paladin to Galena last year. Obviously still a big supporter of Paladin and still heavily involved in the uranium business, because after my time at Paladin, I formed a uranium investment fund jointly with a Singaporean asset management company called Galena Asset Management, and we set up the Galena AM Uranium Opportunity Fund, which we launched in October of last year. And the fund is a specialist uranium equity investment fund, and that's going very, very well, and it's gaining traction, and so that's kind of I remain interested in uranium post Paladin, whilst I continue to lead the evolution of Galena Mining and its business, and still have a number of other board roles.
Very good. Well, let's talk about uranium specifically. It appears as though we are still consolidating the gains from last year within the spot price, and many investors in the space are looking at a breakthrough the $30 range as key. So what are your current thoughts on uranium in general, sentiment-wise, and as well as some of the potential catalysts that could occur later in the year?
Well, uranium obviously is a super interesting one as a commodity, because there's inventories all the way through the system, and historically it's a commodity that people used to buy on long-term contracts and whatnot. It is a commodity that can, I believe, almost longer than any other commodity, it can last out periods of pricing that doesn't reflect the underlying situation in the commodity. And so, it definitely overshot to the downside when it went sub $20 a pound. It's come off its base mainly because of mine closures and a change in the way the traders are approaching the industry, and some specific adjustments in the businesses, really mainly of Cameco and KazAtomProm. And that sort of got it to that $29 a pound mark. But as you say, it's not. It's sort of it's still got a long way to go before the market is normalized and it's run out of puff a bit. What's happening in the market right now is, there's plenty of supply around that $29 a pound mark. There's obviously a lot of traders that bought stock in 2015 at 2016 at sub $20 a pound, and so a $29 price gives them plenty of margin, and there's some traders that are happy sellers at that price. The fundamental change in the underlying buying is really the buying that's coming from Cameco and also the other trading that's happening around that buying. And for reasons specific to Cameco's own internal views, they seem, reluctant to sort of push the bid above that $29 a pound type level. And it is a level where there does seem to be a reasonable amount of spot supply. So I think this is the main catalyst here is when we either run out of supply or Cameco has more of an imperative to buy and therefore moves its bid up, or the utilities really return to the market. The uranium market is still very light utility buying, and that's still something that we have to really watch very closely. So now Cameco, though, when we look at their situation, I'm really focused on their inventories. They ran their physical inventories down by about 70% in the 2018 calendar year. When we look at the rate at which they are consuming their inventories and, how they should prudently run a business, my guess here is that sort of a minimum inventory level for Cameco should be around 5 million pounds, because they have a lot of contract commitments globally in terms of deliveries, and you need, holding inventories as a way of de-risking your business against those delivery commitments. So they finished last year with roughly 7 million pounds left in inventory. So I think when they get down to about 5 million pounds of inventory or so, they probably need to accelerate their buying to meet their contract commitments. And when I look at 2019 year, for example, I believe that in the second half of the year, Cameco is probably going to be buying at twice the rate they were buying in 2018. So now the question becomes: is there still plenty of supply at $29 a pound as Cameco is buying at twice the rate? And by the way, there's other people trading around Cameco's activity and the activity generally going on. So there's financial investors coming into the uranium market now and are sort of making buying and selling decisions based on how they're observing the behavior of some of these big players in the market as well. So it's not just Cameco, it's sort of people watching that trade. But definitely I can see that second half of 2019, there's potential for a break in the current status quo. It could happen much earlier, but that's one of the things that could break the status quo. Another thing I watch very closely when I look at the uranium spot market, frankly, is I watch the Kazakh tenge, right? If you think about it, Kazakhstan is obviously as we've said before, the Saudi Arabia of uranium. It's the biggest producer. Its cost of production, or its very short-term cost of production, is heavily dependent on is Kazakh tenge denominated. The selling price of uranium is in US dollars. Now, I believe that one of the reasons why uranium overshot to the downside in that sort of 2015-16 period is that in 2016 the Kazakh tenge was pegged to the US dollar, and at the Kazakh government decoupled the peg, unpegged the currency, and let it free float, and it went from 140 tenge to the US dollar out to about into the 300s, around 360. So their currency halved against the US dollar at a time when uranium was in the low 20s, and that, I believe, created the situation that led to KazAtomProm taking a longer time to adjust its production for the uranium market, and because they were able to make money at those lower uranium prices because of the impact of the revaluation of their currency. Now, the currency has slowly came back to about 300 versus the US dollar about 12 months ago. But since then, over the last 12 months, it has been declining again against the US dollar, and it's out to about 377. So let's say that, over the last 12 months, the Kazakh tenge has depreciated 20%. And so that's definitely something to watch, in my view, when we think about the timing and the pace of the recovery of uranium prices. So, in the long run, or even in the medium term, we all know the uranium market has to normalize. You can't have a business where underlying consumption is 200 million pounds a year and actual production of the material, including secondary supply, is running only around 165 million pounds. You can't have that situation last for long without sort of a normalization. But short-term swings in important things like the currency of Kazakhstan can impact the pace at which, whether or not KazAtomProm meets its targets to cut production or not. It becomes, if the tenge depreciates further, it becomes tempting, if you like, to not meet to exceed your production target if you're KazAtomProm, because they're still profitable pounds. So these are the sorts of things that I watch. Now, everything I'm talking about, by the way, is about spot market. Now, a lot of people will tell you in uranium, ignore the spot market, it's not relevant because 70% of uranium is contracted. That's a statistic you hear all the time. By the way, you hear that statistic most commonly from people who run undeveloped uranium projects and never actually been in the business of, selling uranium day to day to end user customers. I tell you that in my mind, the spot price is extremely important. I'll tell you why. Because let's say on average, if 30% of the market is spot, then that's all spot. Now the stuff that is on long-term contracts is not on. These contracts are not all set at the UxC long-term, term contract price. Typical contracts have floors and ceilings, and between that they have spot reference, or they have a weighting between the long-term reference price and the spot price. So this stuff that we say 70% of uranium is sold on long-term contracts, well, I can tell you that a good deal of that material might be sold on a long-term contract, but it's actually priced reference to spot. So the spot price is super important. Now, the other thing that's happening is, for various reasons, well, for specific reasons, the market is shortening its tenor. And there's a number of reasons for that. And it's becoming spot is becoming more interesting in general for participants in the market. Now, the first thing is let's think about European US utilities. Well, the reason why there's been such a lack of utility buying in uranium is because they are shortening their tenors. They're running down their stockpiles and they're running off contract positions. Now, one of the reasons why they're doing that is because since Fukushima, there has been a lot more volatility in regulation around the nuclear industry. So, for example, since Fukushima, we have had 3 different presidents in France, and each one of them has had a different approach to the nuclear industry. The first one was pro-nuclear, despite Fukushima. The second one was sort of more anti-nuclear, and the current president is somewhere in between. So if you're EDF as a utility in France, back in 15, 20 years ago, you were sitting there in a business where regulations hadn't changed materially for decades. And so it was much easier for you to sort of sit there and say, look, I'll sign a contract today where the first delivery might be in 5 years' time and it's a 10-year contract. So it's quite typical for utilities like that to, on any specific given year, be committing to deliveries where the last day of those deliveries might be 15 years away. Now, and North American utilities were doing similar things as well. And so these days, utilities can't commit as far out in advance because between now and then, there could be regulatory changes that they need to prepare for. And even in the US, you see that since Fukushima, there's been a lot of change in state-by-state regulation and a split between states of pro-nuclear, anti-nuclear. And so utilities have to deal with a lot more volatility. They cannot see their business, their nuclear business, 20 or 30 years out from today anymore. Their planning horizon has contracted. So that's one thing that means that the shorter term and the medium term markets, including spot, are going to become more important. The second thing I can tell you is that the nature of Chinese state buyers is that they tend to prefer to price their purchasing in the price of the day of delivery, right? So, and we've seen that in other industries. So we saw that iron ore in the time when, the iron ore, the seaborne iron ore trade was mainly a sort of a Japan customer and Australia supplier, and the same for seaborne Pacific thermal coal. Those were products that were sold on term contract prices, whatnot. There wasn't much spot. Now, the emergence of China as the main buyer of those commodities moved those markets to a spot market, and that's partly because the nature of major state-owned organisation, the buyers that work in those groups is they don't want to take risk on pricing being radically different to the pricing at the time of delivery. So a lot of the long-term uranium contracts that Chinese entities have been signing are referenced to spot. And this exactly makes my point, by the way, when people go 70% of uranium is sold on term contracts. Most of the Chinese term contracts are term in terms of they set out volumes over a long period, but they have spot reference pricing. So I think that one of the transitions the uranium market is going through right now is a transition to shorter dating, and that's why we've had such a difficult uranium market, because we've been dealing with the excess inventories that have been caused by Fukushima and the actual disappearance of Japan as a major buyer, but we've also been dealing with the broader regulatory change and the change in the nature and the activities of the utility buyers, and so the market, there's even less demand because the market has been compressing. So now we're very, very close to getting to the end of that compression. When we look at what's the minimum discretionary inventory and contract position utilities can have, it's still an industry where you have this long work in process cycle to go through the cycle from uranium into the production of nuclear fuel. So utilities, when they're down to holding 3.5 years type coverage, they're very close to minimum discretionary levels. And if they continue to stay out of the market to the extent that they have on average since Fukushima, then the longest they can do that is around the 2021, 2022 mark. Now, the smart utilities will preempt that and start buying. It could happen tomorrow. It could happen next year. It could happen the year after. But if it doesn't happen soon, it must happen by the end of 2021. And the longer the utilities wait, the more extreme or the sort of increase in buying that comes from them, and therefore the more extreme the impact on pricing. Now, when we set up our Galena AM Uranium Opportunity Fund, we say to people that we think $50 to $70 a pound is what we call a normalized price range for uranium. And we look at that because we say, look, at the bottom of that range, that's the price that's required to merely keep existing uranium in production. If uranium price does not go above $50 a pound, we will actually see more uranium production cutbacks. As you get into that range and towards the higher end of that range, you get to price levels that theoretically encourage the return of closed production and even a little bit of growth that takes you back to a market where the miners are producing enough uranium, whereby plus secondary supply, you can ensure that the market is in equilibrium. The market is in equilibrium when we look forward over the next 3, 4, 5 years. It's in equilibrium around 210 to 230 million pounds a year, including secondary supplies. So, we need our mining business to, increase by about 30% its production in that period, and that's going to come from bringing back shutout production plus some growth production. And so, and look, in reality, we're in a position now where the utilities have already delayed their return to the market in a meaningful sense long enough that there's no way that supply will be able to meet demand when we come into those 2021, 2022 years, and we're probably having an increasing likelihood of an overshoot event, i.e. the price is spending so long below the normalized range that we're increasing the likelihood that it goes above the normalized range. And for us in the uranium fund, we're very, very focused on getting leverage to that likely appreciation in the uranium price through uranium equities. And at the same time as we care about making sure our portfolio has got the risk to withstand any sort of delay or even a potential, some potential backwards move in uranium price while we're waiting for the real equilibrium to happen.
As we begin to wrap up the show, Alex, let's talk about a commodity that doesn't appear to get any coverage at the moment, and that is lead. You are currently in the process of running an exploration base metals company that mainly focuses on lead and silver. So give us a sense of the supply and demand issues for lead and for base metal commodities in general. Are we now entering a period for base metal commodities to rise higher as a general asset class over the next few years?
So how I focus my career is I try not to focus broadly in the overall mining space. I choose my commodities first, where I want to spend my time in my career. And so I focus on two things: commodities that will benefit with an outsized change in demand due to technology change. So, I'm chairman of a publicly listed lithium company, for example, as well. Or I focus where there's a sort of a unique demand supply dynamic for that commodity, which will, underwrite or make sure that the commodity performance isn't a risk, and therefore, project development in that space or whatnot is there. Now, by the way, uranium has both, where I think over time there's upside to uranium demand as people get more and more concerned about carbon dioxide-free power generation technologies, and plus it has this extreme supply side situation. Lead is an interesting one because it's the most old-fashioned battery metal, around about 85% of lead demand is in batteries. But now lead is not projected to have a sort of a crazy demand profile. Wood Mackenzie expects lead to grow by about 1.9% per annum lead demand between now and 2035. What's happening in lead is there just hasn't been a lot of discovery or development on the supply side. Most lead globally actually comes as a byproduct from zinc mining. And it just so happens that the zinc mines that are coming to the end of their lives at the moment, or have been doing over the last few years, tend to have less lead grade as a byproduct than those newer zinc mines that are coming forward. So lead is in an extreme supply shortage situation. The stocks on the London Metal Exchange are at record lows, and going forward, it looks very, very difficult to see where lead concentrate supply will come from. Now Galena Mining, where I've joined as CEO, is actually no longer an exploration company. It's been a great company. It listed in September 2017. It's a relatively new company. It's been very, very successful with a more than 20,000 meter drilling program, and it's been through the pre-feasibility stage to conceptualize a mine called the Abra Base Metals project in Western Australia, very low risk established mining jurisdiction. Now that had for $154 million capex investment, Australian dollars, it's got a pre-tax net present value estimated at $528 million, just using spot prices, no crazy pricing there. And the internal rate of return of building that mine is 50%. That for a tier one country jurisdiction, you very, very rarely see base metals projects that just using spot prices have such high returns. Now, at the very, very end of January, a couple of weeks ago, we announced a deal with Toho Zinc of Japan. Toho Zinc's got about a $1 billion enterprise value. They have zinc smelters and a lead smelter in Japan. And by the way, they also own a wholly owned mining business in Australia and New South Wales called CBH Resources. They proposed to invest 90 million Australian dollars for a 40% stake in our project in Abra. That 90 million is the equity we require to build that project. So we're hoping to close this Toho deal within the month of April. Assuming that deal closes, then we have the equity. We're finalising the definitive feasibility study, and that enables us to move forward and close a bank project financing facility as well. So this with Toho's money, Abra is going into the construction phase, and we aim to be in production in 2021. So it's a very high return project. Of course, the stock has been going very, very well, but it's in a commodity where the dynamics of that specific commodity are very interesting to me. You won't see my name attached to a coal mine development. I'm not really interested in iron ore right now. There's a few other things, but where I can specifically pick out the commodity dynamic and then find very, very good quality projects in that, then that's where you'll see me try to focus my work, and and that's where I think I can create value, and I hope that shareholders and investors can see value created on their behalf as well with that strategy.
Okay, well, thank you very much for your time today, Alex, and I'm sure we'll have you back on the show later in the year.
Okay, I appreciate that, Kerem. Thanks for your time.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?